Every data point is weighed before the opening bell rings. Traders analyze overnight, global futures, and local sentiment to map out the first moves of the session. Blind spots in this environment are expensive. Overlooking a single localized news trigger can mean sitting on the sidelines while a major rotational swing takes off. The pressure for today's session is centered here in Mumbai, where initial domestic data sets the baseline for market volatility. A sudden downgrade in meteorological data is the central variable for today's session. The weather department has lowered rainfall estimates, signaling a deficient monsoon. While the broader indices have maintained a cautiously bullish tone, this specific weather anomaly creates an immediate structural headwind for the domestic economy. A downward revision in rainfall translates into agricultural deficits. Lower crop yields constrain the food supply chain, historically forcing a sharp upward spike in food inflation. The risk is a physical reality. Extended dry spells and drought conditions directly compress agricultural output across the country's interior. This physical friction drains disposable income. When farming communities anticipate lower harvest, spending slows, creating a vacuum in consumer demand across rural territories. This triggers a corporate chain reaction. Companies with heavy revenue exposure to these regions face a contraction in sales, which drags down upcoming quarterly earnings. For institutional money managers, a weak monsoon forecast acts as a mandate to reposition. It dictates exactly where billions of dollars will move before the retail market even registers the shift. To navigate this threat, foreign and domestic institutional investors deploy a targeted defensive mechanism, sector rotation. This chart shows institutional capital rapidly reallocating away from rural dependent businesses to concentrate in urban demand and defensive sectors. Fertilizer companies are among the first to see outflows as investors price in the expectation of lower chemical applications and reduced crop yields. This capital flight is a direct reaction to the slowdown on agricultural manufacturing floors, where agri inputs sit idle as demand contracts. The rotation impacts the entire rural ecosystem. Heavy agricultural machinery manufacturers and microfinance firms built on rural lending face similar exposure to this localized drought. Holding a broadly distributed portfolio through this contraction creates unnecessary drag. Profitability requires matching the agility of the institutional money currently rotating out of these sectors. If the domestic rural economy is facing such severe contraction, the question is why the broader Nifty index has not broken down. The answer lies in a massive counterforce. Global macroeconomic tailwinds are providing a floor, holding up the ceiling for the broader Indian market. This buoyancy originates in US markets, which continue to hover near record highs, exerting an upward gravitational pull on global equities. Momentum is concentrated in the capital flows directed toward artificial intelligence, driving fierce buying power into global technology infrastructure. Risk appetite is also recovering due to easing geopolitical tensions in the Middle East and the cooling of Brent crude prices, which offers relief to India's inflation outlook. We are witnessing a collision of opposing forces, a downward drag from local agricultural data meeting a surging upward current of international capital. Indian equities are currently caught in a tug of war between an accelerating global technology boom and a localized agricultural deficit. When global momentum collides with local economic friction, the result is elevated, unpredictable volatility across the indices. The residual lag effects from previous high crude prices layered over current monsoon fears act as an accelerant for erratic price action. The market is no longer moving together as a unified block. Success now depends entirely on stock-specific execution and selection. Active traders must exercise intense discipline. This requires monitoring the opening hour of the session to secure clear trend confirmation before committing capital. In a divergent market, relying on broad index direction is a liability. Precision targeting of sectors receiving institutional capital is the reliable path to profit. This chart demonstrates the parameters active traders must isolate. Defining key support and resistance zones in Nifty and Bank Nifty is critical. Surviving volatility requires strict risk management, restricting execution to these specific high probability entry zones. Traders must strictly control their position sizing. Keeping exposure tight allows a portfolio to survive the false breakouts that occur when macro forces clash. When precise technical setups align with institutional capital flows, the resulting market price action is fast and aggressive. Success in this environment depends on tracking these specific weather and capital rotation triggers. Monitoring these signals provides the lead time necessary to anticipate the next breakout.